In this video, I will quickly show you how to analyze the concept of capital flow from the fundamental perspective. Capital flow. In forex market, when we say capital flow, what we mean is the movement of money or fund from one country or currency into another country or currency. Now, let's pick an hypothetical example. Let's say we want to analyze USD JPY. You need to identify the country for USD JPY. The country A will now be USA, and of course, country B will be Japan. Now, on the overall, the direction of USD JPY will be determined by some fundamental indicator. And of course, this fundamental indicator is subdivided into two parts. We have the economic stance or economic indicators, and we have the geopolitical indicator. Now, I'm going to pick one example for each of these subgroup so that we'll use it to analyze analyze capital flow in the context of JPY using the perspective of fundamental analysis. Now, as of today, 12th of May 2025, the interest rate for USA is 4.5. and that of Japan is 0.5%. So for economic indicators now, I'm using interest rate, which is one of interest rate divergence, which is one of the core indicators you are to consider when you are analyzing capital flow from the perspective of fundamental indicators. So now when you compare the interest rate for USA with that of Japan, you will realize that there is a difference of 4%. Now that 4% is what we refer to as interest rate divergence. And of course, if you are a trend following, if you trade trend following strategy, it is expected that if there is a country or there are two countries with divergent interest rates, the currency pair for those two countries will have a clear trend, whether a downtrend or an upward trend. In this case now, because now we have USD JPY, now the base currency is USD, while the quote currency is JPY. In this case now, USD, the interest rate is 4.5, while the interest rate for Japan is 0.5. For USD JPY, it is expected that this currency pair is going to trend nicely to the upside. Why? Because through the activity of investors in terms of carry trade, let me quickly explain what carry trade means. Investors knows that in Japan, for you to borrow money, all you need is like 0.5%. So like a rational investor can go to Japan, borrow money at the rate of 0.5%, now transfer that money by exchanging Japanese yen into US dollar to buy an asset in USA. And of course, when the capital flow from Japan and get to USA in terms of US dollars, and you use it to buy an asset in USA, you are expected to make higher return from such an investment, which of course you still have differences between the 4.5 and 0.5. You will still make money eventually. So that is what we call carry trade. When people move to a country with very low interest rates, they get their capital, maybe in terms of they borrow their capital from such a country and move that capital to an high yield currency like the USA, like the case we are considering now. So when there is carry trade engagement, is going to make the demand for US dollars to be on the increase relative to Japanese yen. And of course, when the demand of anything increases relative to the supply, the price of such commodity or an asset or anything is going to rise. So the US dollar, the price of US dollar as compared to Japanese yen will eventually be on the increase. That is why you will see a clear trend for USD JPY for this season, provided that there is established risk on sentiment in the market. Now, let me quickly explain the geopolitical indicator. You can imagine that there is now war in USA. If war, maybe let's say war now broke out between USA and United Kingdom, and a rational investor want to move their money away from USA regardless of the interest or the high yield that such an investment promises to give them. This is because there is a geopolitical tension, or there is a geopolitical factor that will affect the position of the economy in question now, the USA. So if you have any geopolitical event, maybe there is war, it might even be maybe a regional conflict that has the tendency to affect USA as an economy. Such a geopolitical stance is going to affect the movement of capital between Japan and USA. So apart from the economic indicator, which of course when there is a risk on, which means there is no geopolitical tension, there is no war, there is no pandemic, there is no regional conflict anywhere, and average investor wants to move their capital from low yield currency or country into high yield currency or country. Of course, that is economist stance or indicator. But because you are analyzing from the fundamental perspective, you will still need to consider the geopolitical stance to know that, okay, do we have any war? Do we have anything that can disrupt the supply chain? Do we have anything that can affect either of the economy? It's after you have analyzed that you can now say, okay, of a shorty, we are in a risk on, and of course, I can move my money through the activity of carry trade from a country or currency of low yield into a country of high yield. And this is how you analyze capital flow from the fundamental perspective. In the subsequent video, I'm going to show you how to really pinpoint capital flow from the sentiment perspective. I've just touched briefly on how sentiment interplay in terms of geopolitical indicator or geopolitical stance, but in this second part of this video, I'm going to now expatiate on how to analyze capital flow in real terms when there is shift in sentiment, and even how to track that sentiment that will cause capital to flow from one country to the other. I want you to stay glued to this YouTube channel because you'll be getting a lot of value, and of course I don't want you to miss out on any of this. These are the summation of tactics that we employ in trading our launched trading system to give us consistent profitability in trading. I want to encourage you to get each of the video and follow the training step by step so that you can understand the progression and how to view the market as a professional. Thank you. God bless you.